on. We'll just give it 5 minutes for other people to join in. I think we're still seeing people come in. We'll just give it another 2 minutes before we start today's webinar. I hope you all can hear me and you can see the screen. Okay, perfect. Thank you. All right, I think we can begin. We're close to 11:05, so anyone who joins in beyond this is welcome to participate. So before we get into the substance of our webinar today, I thought we could take a minute to sort of look at how we structure this. So we're going to talk about where markets are today, as well as what good investing looks like. And then we'll talk a little bit about the work that we're doing at Sphere in terms of the PMS, being a multi-asset strategy. And we'll also have some time for Q&A towards the end. So anybody who has a question, please feel free as and when it pops into your mind to type it into the chat box or in the Q&A section of the conversation. And then we could definitely take up all of this towards the end of our webinar. So thank you everyone for joining on time, whoever is here. And without further ado, let's begin our conversation today on good investing in bad markets. So I think the first question is, are we really in a bad market? And I think there are certain things that are making us think that things could get much worse from where we are today. So amongst them, you have a lot of uncertainty because global economies have been extremely leveraged in the last few decades. So if we look at how the US's balance sheet has been, they own close to 7 trillion in assets. They've been trying to shrink it. And every time the US has gone into this tightening mode since the global financial crisis, you've had something that's hit them, which has forced them to sort of backtrack in what they're doing. But there is this gradual deleveraging that is happening or that must happen at a global scale. Uh, in comparison to other economies, I think India stands out quite well because we have a very manageable fiscal deficit, and there has been a lot of discipline as well as action towards bringing the deficit down. And there is a consistent glide path that the government has been able to follow. So we are not actually dealing with deleveraging on our own in a very massive or how do I say, disruptive way that the West is dealing with it. Correct? Yet we live in a globally connected world. And that means that any big shifts that are happening in one economy, there are going to be ripple effects in other economies. So we can't isolate ourselves from the rest of the world, even if our balance sheets are healthy and we have certain advantages. What happens in the world is going to have an impact on how we look at Indian uh, markets as well as the Indian economy. So moving on to the second thing, which I think is front and center of all headlines and news today, is tariffs. So there is a significant amount of policy uncertainty around tariffs because you have two heavyweights on the global platform who are not willing to back down and who have not been able to negotiate a deal that works for both of them. So if you're looking at US-China relationships, I think in the last round of tariff escalations, that is in Trump's previous presidency, you had a lot of uh, the tariff war restricted only to the goods and services that were there. Whereas this time, I think you're getting financial assets into the marketplace as well in terms of what you're doing. And I think the second key thing is that both parties are unwilling to blink and say that, okay, let's de escalate what's going on here. So that kind of deadlock is creating a lot of uncertainty for businesses. So businesses are unable to plan their pipelines. This is going to upset your logistics ecosystem. It's going to change the nature of trade. It's going to change the agreements that these countries come to terms with other trading partners, right? So as long as this policy uncertainty is there, you're going to have global market volatility. You're going to have very unexpected alliances forming, and any uncertainty is actually not really good in terms of business visibility. So you could have very rapid shifts in valuations that occur because of policy measures that are getting taken. And the last thing I think we need to look at is that there are some macroeconomic shifts that we've not really been paying too much attention to. So the US has been in a low interest rate environment for a very long time. And then you had a rapid uh, sort of series of rate hikes and a tightening of monetary policy that occurred in the last few years. And now you're trying to gradually slow that or release that tightness that's there in the ecosystem, which again is building up pressures in different places. So one thing that we can understand, if you're doing this deleveraging, if you're maintaining higher interest rates than your past average, if there is a lot of uncertainty around goods and services because of tariff policies, you are going to see a higher level of inflation. So whatever we normalized or whatever was considered a normal level of inflation in the past is no longer the same thing today. We do need to look at how to think about inflation and how to structure or provide for inflation within our portfolios as we move forward. So now thinking about where we are in the market cycle, I think one thing that's clear is that there is a lot of talk about, okay, are we in a bear market? If you open the page, if you open the newspaper, you see these really ferocious bears dominating the headlines. And it's time for us to sort of think about, okay, what are the phases of a bear market, right? Like, how does this work? What is the psychology or what are the feelings that are associated with a bear market? So I think your initial phases, there is still a fair degree of confidence and conviction that markets will bounce back. So people think that, okay, this is just a correction. There's the whole buy the dip mentality that's there. And we saw a lot of that happening in 2024. So every time the markets corrected, there was a lot of flows that supported the market movement or that countered any market movement, to be more precise. So that mentality of, okay, this is just a correction and like, you just need to buy the dip and move on to the next thing. That phase of the bear market is clearly, I think, at some level behind us. You still have a lot of retail participation. If we look at AMFI data that came in from March, there's a clear uh, structure that people are still contributing SIPs, people are still looking at small and mid cap, people are still looking at themes that are considered to be expensive from a valuation standpoint. So I don't think we're fully out of this phase, but it's definitely, there are people who are starting to wonder about whether this is more than just a correction. and whether things could really get worse from here. So that level of despair also is not yet prevalent. And I think from there, what tends to happen is that you reach a bottom where your economic indicators are really not very positive. You see that news is only pointing towards worse outcomes, and behavior also triggers that. So then uh, I think that's when people lose complete faith in the market and they walk away from equities. And then when equities start recovering, because they say that markets are a leading indicator, meaning what happens in the market signals what should happen in the economy. So your equity markets start reacting before the economic data comes in, and that's when people are more skeptical, thinking that this is not yet over, right? So if we see where we are, I think we're still somewhere in phase one of the bear market. We're not really at a point where people are completely panicking or completely worried about how things are going. There is some level of reconciliation with the fact that we're moving into a tougher macroeconomic environment, a tougher global environment, that people do need to focus on a valuation reset. All of this is definitely there. But I do think that we're not yet in a state of despondency. So this is where investors need to mentally and financially prepare for tougher times. And that involves doing a few things right. And we'll talk about how to be a good investor in markets like these in a later point in the presentation. So let's first look at how bad the markets are today. So this is data from DSP's Netra. They publish a series of charts every month and it's quite informative. So for any investor who's keen on tracking some trends, I think it's worthwhile looking at this selection of charts. So if we look at how bad the market has been in the past, I don't really think we're there, right? Meaning you had some drawdowns, your worst 20 days. If you see, there are certain uh, phases where it's been anywhere between, say, 7 to about 13%. And if we look at today's volatility, I think last year our VIX was around 15%, sorry, 15 as a number. And now in the last few weeks, you've had a sudden spike in volatility and you're at the 20 sort of levels. But even 20 is not a very high level of volatility. What we actually need to measure is the day-to-day jump. And I think the day-to-day jumps have been a lot steeper than many investors have anticipated. But if you've been checking your portfolios, if you've been tracking the markets, I think you definitely notice that um, there are sudden sharp dips. That what happens at the index level is really not reflective of what's happening at the portfolio level, meaning your portfolios are probably seeing a lot more volatility than what's happening in the index, right? So we need to look at where we are. So there's another chart also which I would like to show you, which sort of reflects how broad the correction has been. So if we compare what's happening in March 2025 with, say, the global financial crisis in 2008 or the COVID crisis, I think you are seeing a more broad-based fall here. So if we look at the number of stocks that fell from 0 to 10%, it's about 2% of stocks. If you look at stocks that fell anywhere between 10 to 20%, that's about 10% of your market. And then if you go into the next brackets, you're looking at 20, 30, or 25% in terms of 40 to 50. But if we see the number of stocks that have really halved their market cap, I think that is less compared to these crises. So we're not in some deep value where, companies are being crazily discounted. So for investors who are thinking that, okay, this is a time for me to buy, you're not getting that value buy yet. What you are seeing is maybe some level of re-rating that has to occur, because we've had very good years. And if you've been tracking the kind of content and data that we put out every quarter, our head of research, Mr. G.R. Banerjee, does a presentation on corporate India. So you can see quarter on quarter what we've been saying in terms of how earnings commentary indicates that there's been a slowdown in the economy. We've also talked about how margin expansion was a great thing for a couple of years, and now you have to like normalize, right? So there is a whole re-rating cycle that needs to happen on fundamental triggers, and you're also seeing a slowdown, and you're also seeing global uncertainty. So this is the time where I think an investor needs to be a lot more discerning, a lot more selective about where they participate, and have a razor sharp focus on risk management. So, what's the secret to success? I think we always like to quote Charlie Munger, and I think the first thing we need to understand is the nature of markets. The last few years have got us believing that markets are this, this one-way trajectory that year on year you're going to see positive returns, but that's really not the true nature of a market. In financial markets, you're going to have these ups and downs, and there is actually no foolproof method to avoid the tougher parts of the market. If you want to create wealth, you've got to be there in the good and the bad times. And the only way that you can sort of try to avoid this bottoms is to time the market. And one of the wisest investors calls it a seriously dumb thing to do because nobody really knows where the market bottom is. Nobody really knows how to catch the bottom or avoid the bottom or avoid the messier parts of the market. You've got to be participating throughout. So, what is he saying? What does he think the success secret is? And I think here it is to be conservative with your investing and be steady with your savings, meaning be consistent through this period and don't expect any miracles, right? I think there's always this performance chasing that happens in every cycle. So don't expect that something is going to miraculously double or go 10x from where you are today. I think it takes a lot for those kind of things to occur, and you actually want to succeed in a manner that is repeatable, right? If you're trying to create wealth, you want to have that repeatability so that you ensure that through your entire investment journey, you're able to create wealth in a consistent and sustainable manner. And it's not uh, something where you're looking at a one-off or a one-time wonder, right? So moving on to our section on good investing. So what is good investing? I think for an investor, when you say that this has been a good investment, what you mean is that your returns have been consistent. That when the market corrects, you've had smaller drawdowns. That your entire journey has actually been quite peaceful, right? You've not been stressed about what's going on in the markets. You've not been worried that you're losing money doing certain things. That's a very, very important component of wealth creation, which is rather underrated. You want your success to be repeatable, right? You don't want something that creates wealth for you once and then stops working. You want a process oriented approach to wealth creation. And of course, we all need to be goal oriented. And I think that is at the investor level. You need to know why you're making certain investments, what they're going to get used for, when you need to, you use these investments to fulfill a particular goal. So that ownership has to come from each investor. And you also want to have a stress-free approach to investing. You don't want to be concerned too much about what's going on in the market because when you're stress-free, you're able to consistently participate. And when you consistently participate, the miracle that you're seeking for will occur. So we narrowed it down to a few things. I think the first is in terms of contrarian investing, right? So if we, sorry, if we think about contrarian investing, I think you need to understand that what the market does is not what you need to do. So uh, there are always extreme emotions that occur in a market cycle, and you see that people will flock towards one thing or the other. And to be a contrarian investor, you kind of need to do what is the opposite, right? You need to get your timing right. You need to take a stance that no one else is willing to take. And at the same time, your stance needs to be not too early and at a meaningful allocation. That means, if you get your call right, but you get the time wrong, there's a famous quote from Howard Marks that says, being too early is not very different from being wrong, right? So if you're too early in your contrarian stance, then you tend to be wrong for a longer period of time. And that can again affect your confidence as an investor. So I think you need to look at contrarian investing from a multi-asset lens as well, and also from a value investor's perspective, because I think when you look at value investing per se, it is in its own way a form of contrarian investing. So when we talk about value investing, let's take this famous quote from Seth Klarman, where he says that it continues to be the best and perhaps the only reliable North Star for those who are able to remain patient, long-term oriented, and risk averse. So if you're actually a conservative investor, then I think the approach to investing needs to be more value conscious. Because when you're value conscious, you're protecting yourself from the downside by being very disciplined at what valuation you buy a particular idea. When you're also value conscious, you're ensuring that there is some upside potential for you to capture as well. So on both sides, being a value investor really protects you from losing too much money in the market. At the same time, contrarian investing allows you to make that extra return because you're being quite cognizant of how the market psychology is, and you're always able to get a little bit of extra by being able to work through the market's emotions. So I think value plus contrarian investing is one part of the solution because it ensures that you're able to repeat your success, primarily because this is a process-oriented approach. If you're being disciplined about what valuation you're participating in, if you're being disciplined about taking a stance and making sure that you're choosing the right time and the right scale at which you take that stance, it ensures that you're able to repeat your successes. And this is something I think when we look at our own track record as an investment advisor or a PMS solution provider, we have been able to repeat successes. We've been able to have a broader baseline for what is performing in the portfolio, primarily because of these two characteristics, right? But what is the third element that goes into making a successful or a good investment strategy? And I think the third element is multi-asset investing. So Peter Bernstein has written a great book, and I think it's all about risk, right? So when you think about multi-asset investing, most people think about this as, okay, it's just diversification, right? Um, and but diversification is not just about putting things in different places. It's not just a survival strategy, but it's actually being aggressive because the idea is that assets also move in cycles. Their valuations change with each part of the cycle. And if you're able to judge the fact that some asset is in a down cycle, some other asset is in an up cycle, you can actually capture a windfall from this. And it's always a surprise where the next asset run is going to come from, right? So if you looked at, say, COVID in 2020, a lot of investors were writing off gold as a performer, primarily because you had your equities rally again, then you've had cryptocurrencies come and take front and center stage. So precious metals as a basket were kind of written off. And even if investors later gave some attention to gold, I think the best performing asset class of last year was actually silver. So each asset goes through cycles, and I think we need to pay attention to those cycles to be able to capture these windfalls that come from them. And why does multi-asset investing work? I think there's a really nifty chart that comes from Bandhan where they talk about what are the correlations between different asset classes. So a correlation is a mathematical concept, and the idea within portfolio construction is if I can have a bunch of assets within a portfolio that are not fully positively correlated with each other, then I am able to perform in a wider range of scenarios because my portfolio is not going to move in a linear direction with the market, right? So if we look at asset correlations, having a mix of fixed income, precious metals, and equities ensures that we're able to capture some of these low correlation relationships as well as negative correlation relationships. So, this spread of assets within a portfolio actually can give you a much better outcome in the long run. So, multi-asset investing is built upon the principle of low correlations, right? So this ensures that your returns are more consistent because you're able to perform in a wider range of scenarios. It ensures that you have smaller drawdowns because if one asset class is an underperformer, not everything is going to underperform in your portfolio. It also makes sure that your success is repeatable. And I think this is where you get stress-free investing because if you're able to repeat successes, if you're not dealing with the anxiety of large drawdowns on a consistent basis, and you're able to look at how to do certain other things, then I think your investing journey itself is going to be a lot more peaceful. So if we look at the drawdown that has happened, let's say you have your blue chip pure equity index like the Nifty, the drawdown from the peak of September to last month, March, which was the bottom, I think, if we take even this week's data into account, the Nifty fell almost 19%. At the same time, if you had invested in Sphere, I think the drawdown here has been around 11%. And if we look at a multi-asset index where you have, say, only 50% allocation to stocks, that index has fallen about 9%. So clearly, you need to keep cool. You need to be able to outperform your benchmark. You need to be able to capture the upside and participate less in the downside. And I think that's where Sphere sort of comes in and fits in quite well. So I want to quickly share our performance as of 31st March. And if we look at how our performance has been, I think consistently we've been able to outperform our multi-asset index. And this comes from having some diversification across our uh, asset classes. So as you can see, we have some cash, we have some fixed income, equities have been a large part of our portfolio. And we have some allocation to global as well as precious metals within this space. And if we benchmark ourselves against peers, I think we still stand out. So if we look at whether we've beaten our index, the Nifty 50, if we've looked at specific multi-asset funds within the industry or a category of multi-asset as well as dynamic asset allocation or even flexi-cap, right, as a category, I think we have been able to outperform all of these on a 2-year basis. And our since inception returns also show that we've been able to stand out tall in this environment. So quick look at our team. We have a lot of people working for clients to ensure that investors get the best output. There is a research team, there is a strategy team, and of course we have a very talented set of fund managers who are ensuring that we're able to do the right thing for every investor in this market. So with that, I would like to open up for questions. I do see some things already on the chat box. So let me start getting to them. Okay. If the market was expensive earlier, why the stocks were not sold in bull market, which would help build up cash reserves and invest when the valuations become attractive? I am asking from a solitaire perspective. So I think we have always been value conscious, and I think if we look at how even solitaire is structured, and I'm of course not on the investment management team for solitaire, so I would not speak in detail about this. But if we look at what we are owning, right, there is always a 3 to 5 year perspective, and even in this correction, I don't think you're looking to exit those ideas. Solitaire falling is partly because if you compare with the benchmark, it's because they don't have exposure to banks. And that was a conscious decision because the nature of that portfolio is that they don't want to invest in leveraged companies. So at times this can be a positive, at times it can be a negative. And if you look at what has done well in this market cycle, so why are you seeing that big difference, right? So banks and financial services have actually pulled the market up in this phase of drawdown. So on both sides, you're seeing a negative thing. You've not participated in something that has gone up because it's part of the portfolio mandate. At the same time, the rest of the market has fallen. So that is the thing. So when we are fairly value conscious, and I think if you've been a long-term investor, you would know that this is how Solitaire operates as well. All right. So to the second question, say we cash out when the market is expensive, but the market doesn't fall, earnings improve, and valuations are fair for a while, resulting in a rally. In that case, are we missing out the rally by cashing out completely? So I'd like to tie back to the quote that I shared from Charlie Munger, right? Timing the market, according to him, is seriously dumb because these things can happen. Meaning, you might think you're at the peak, but you may not be at the peak. And let's say we're talking about this hypothetical situation where you've taken money out of the market, but the market doesn't fall, and then you see that the market is going up. And then at that point, we've seen that behavior will trigger this FOMO factor, where we feel that, okay, like, I was wrong about that. Let me put my money into the market now. And then when you do that, again, the market corrects. So I think here is where it matters, right? You need to consistently save. You don't need to pay too much attention to these events. When there's an extreme, it will be obvious that there's an extreme, right? We know extremes by their nature. It's going to glare you in the face. So if as long as you consistently participate, I think this year, if you phase out your participation, like if you have money, then don't put all of it in the market now. Like phase it out. There will be opportunities. There's so much uncertainty in the global ecosystem that you do have time to uh, gradually participate and make sure that you're creating wealth. So this is not a 1 month phase or a 2 month phase. I think it's going to be much longer. Maybe for 12 to 18 months, you need to be mentally prepared to grow your portfolio. This is the time to plant seeds. What is value? It depends on one's perspective, isn't it? Yes, you need to have a framework, you need to have a filter system. Nobody's really going to agree with you as to what a value, like what is value, what is expensive, what is undervalued. But you need to have a framework, and that framework needs to give you confidence, and you need to be able to use that framework to repeat success. So every cycle will give you something that you can iterate and improve your framework with. And I think you can always look at historic levels to sort of understand whether you're in that range, out of that range, and see whether there's a new average that needs to be built based on current developments. What are my thoughts on the RBI rate cut? I think if we look at the minutes, I mean, I have published a video as well on the iThought Connect channel, which outlines what all occurred in the meeting. But broadly, I think the commentary that's coming in from the RBI is that they are far more worried about growth than they are about inflation, because the big triggers for inflation are now behind us because food inflation has stabilized to a certain extent. The real tricky part is global, right? Because we might end up with imported inflation based on how the tariffs are. There might be a big slowdown effect also that's trickling into India. Globally, there's a slowdown. So if we look at the commentary that came in from the RBI, I think one thing is obvious, which is that they've cut the interest rate. But the second thing is that they've clarified that they've changed the stance. So the stance has gone from neutral to accommodative, signaling that you are seeing more risks to growth than you are seeing risks to inflation. So that shift gives us a lot more clarity about what they are seeing. And I think that also is a signal that this could be a deeper rate cut cycle than we thought, say, a few weeks ago. Yeah, correct. I think there is a quote also that says all investing is growth investing. So whether you're a value investor or not, I think you are looking for growth, right? Even when you are a value investor, you find it attractively valued only because of the growth angle. Okay, so there is this question. Even though it's so obvious that multi-asset allocation, diversified investing is the logical way as data also shows, but still why neither the investors nor the advisors tell to follow the same? Why common sense is not so common when people chase returns and greed takes over? Also, most advisors and MFDs push clients for full equity. Is it for commission basis? See, like I think I can only talk about our experience at iThought. We have a multi-asset product on the PMS side that is open to investors. If you look at what we were trying to do in the last few years, we have done a multi-asset approach in the mutual fund distribution side as well. I can't speak for the industry. I think as far as investors are concerned, also it's difficult to speak for them, right? I think most of us go with what we think is best at any point in time. And what looks to be the best thing might be a pure equity strategy or a high risk strategy because most decisions are made based on recent returns or past returns. But returns are cyclical in nature. And if that's the case, then if you have a very good performing asset, it's unlikely that in the next 5 years it's going to give you the same kind of return. But it'll take time for people to understand this. What is the difference between contra and value? I think value is where you're trying to understand what are the fundamental triggers, right? How much is something really worth? In contrarian investing, there is also an element of psychology that's involved, where you're seeing what is the market think and why is the market saying that this asset is either worth so much or worth so little. And when you're able to sort of separate the psychology from the fundamental triggers, then you're able to identify certain ideas that are extreme in nature. Meaning, you see that, okay, like, people are saying this is not worth anything, but actually, there are a lot of fundamental positive triggers that are being discounted more than they should. I think there was some data that was published that the recession probability has increased, but it still doesn't look like a very high number. Uh, so I don't think yet. I mean, there are always chances, right? If we're talking probabilistically, yes, there is definitely a probability that there is a recession. Is it high? I don't think so. What is the opportunity? What is the best investment opportunity for a 2 year tenure? Uh, I think it's tough to say at this point, but I would not want to put my all my eggs in one basket. I would prefer to take a multi-asset approach because fixed income is signaling positive triggers. Precious metals is good. Maybe within 2 years, we don't know how fast or how steep the correction will be, right? So if you get equities also at a reasonable valuation, maybe that could be a good asset. So I think in today's context, more than ever before, multi-asset investing makes sense. How long will it take to deploy the entire 50 lakhs given market conditions in the sphere PMS? We don't deploy everything on day one. We do a very gradual deployment, and that is on a day-to-day basis. So let's say on a week like this, when you had like a sharp drawdown on one day, you can participate more. When you don't have, if the market is rallying, then equity allocations will reduce, other asset allocation might increase. So I think anywhere between 1 to 2 quarters, you might take to deploy the money. Is it time to invest in global markets like global funds or any particular country since the tariffs? No, I think the reason indices are taking a hit are because there is uncertainty, right? Meaning you don't know which company is going to be affected, how much. They are not able to plan for these things. So I would not want to jump into any global investment decisions right away. Let me just head over to the Q&A section. I think there have been some questions here as well, which I would like to take. All right. If 50 lakhs is given now, what would be the sphere investing strategy? For example, how much will be invested and in what instruments and how much will be maintained in cash? I don't think we're allowed to disclose this, and it's also a fund manager decision on the day of investment. So at that point, we are informed what should be done. So we don't have a fixed framework in which that's being done. But I think deployment is slow. I think there are a lot of opportunities in this market. So maybe it will take a quarter or so for the full deployment to occur. Okay, if the market was expensive earlier, okay, I think I have discussed this question as well. All right. So okay, sorry, I think I missed this question. It came in a little earlier as well. How much AM in Sphere and how much AM in iThought PMS? So Sphere is close to 600 crores. We're below 600. I think we'll be around 560, 570 crores. Totally, iThought PMS is more than 2,500, closer to 3,000. I hope that answers your question. So we still have about 15 minutes. And if there are any more questions about the product, what we do, why Sphere is, um, okay, I have one question. What is the expense ratio applied for PMS? So we don't have an expense ratio. We have a fee, which is slightly different from what mutual funds have in terms of an expense ratio. We have a flat fee structure of 1.5%. So that means that's the fee regardless of what the performance has been. So in a year where you perform more, there is no profit sharing that occurs. In a year where there is a drawdown, there is no change in the fee structure. So over and above this 1.5%, you have GST, and to open or operate a PMS account, there is a custodian, there is some demat charges. So all of these additional charges would also be there, which would be under or around 0.2%. We don't have a direct and regular plan. As of now in Sphere, we have been working directly with customers. And I think there are limits, but if we have been quite competitively priced in terms of what the PMS expense is. Uh, Regarding gold, I think, see, we have been very early adopters in gold. Back from 2018-19, we have started investing. So I think for us, this is the point where we might look at doing some profit booking, and we are not really looking to buy or scale up gold at this point. We prefer to do things from a value conscious perspective, and I think given we also have to assess the relative merits of all asset classes today. So I think if you're referring to capital calls around events, it's not so much about market timing as there is a clear policy change that might come in, right? So if there are events, we have to respond to them. Similarly, uh, if you are looking at certain events or triggers. Like if I look at the RBI meeting, if I was expecting a rate cut, there might be certain actions that we can take with respect to that. If you're looking at the budget, if you're expecting certain things to come in, then there might be actions that you can take with respect to that as well. So I think if we look at events, there are definitely triggers that would make us be more active. It's not about timing the market. It is about looking at the fundamental drivers that come from those events. So I hope I'm able to explain that clearly to you. I think if we're also looking at the deployment, uh, your tariff uncertainty was not so high in end of January, right? And if we had seen how the markets were, I think from September to January, we had a continuous sort of drawdown phase. And when you see that reallocation, etc., I think there might have been buying opportunities there. Thank you, sir. I think if you believe us, that is enough. We don't need to be ranked number one in India. I think we are working for the investor as long as the investor feels that it's enough for us. I don't know actually who is the best. I think we just try to do what we can do best. Is this the right time to invest in contra fund? Again, I think if you're looking at mutual funds, you need to understand the manager's philosophy and the framework for the fund before selecting it. Because, see, categories give you a broad idea of what the fund is supposed to do, but style is such an important factor, right? And that's not something that many of us give enough importance to, or we spend time analyzing the fund manager's style. If the fund manager style suits you, or if the framework suits your risk appetite, then sure. Yes, that's absolutely right. In the PMS structure, taxation is upon the investor. So if there is any sale of securities, depending on whether it is short term or long term in nature, the client will have to pay the tax for that particular transaction. If I want to invest 1 crore, do you recommend Sphere or Solitaire or both? And I want to hold this for 5 years. I think this decision would be based on what your expectations are. We do recommend pairing PMS portfolios for certain investors. We recommend one product alone for certain investors, depending on their risk appetite, their expectations, and their capacity to participate throughout. Because if you're talking about the next 5 years, I think there will be multiple calls for capital, right? So if an investor is not going to be able to fund both accounts, then we would choose what is best for them. If they are having the ability to participate in both accounts, then I think it makes sense to have a broader approach. Because in MF, this asset allocation cost is borne by the AMC and not passed on to us, while in PMS, is it on us investors? Yeah, I think that is something you might have to take up with SEBI, right? Like it's not something that we can do anything about. Tax is tax, we just have to deal with it. Why mutual funds are performing better at a time is performing upside down due to change in philosophy or fund manager or due to market corrections. I'm sorry, I don't fully understand this question. Are we asking why there are phases where mutual funds are performing well and phases when they're not performing well? And is that because of the philosophy or the fund manager or because of market conditions? I think it's all three, right? Like if you have, I mean, performance is not always going to come in. There can be phases where a fund manager underperforms because they're managing risk more than they're managing return. And that doesn't necessarily mean it's a bad fund. It might mean that the fund manager is sticking to a certain philosophy and market conditions are also playing a role in that underperformance. It can also be the other thing that the market is down, so the fund manager is down and they've not really managed risk very well. And but I think upside also it depends on the same thing. Yes, we are quite positive on fixed income right now. We think that in the current context, it makes a lot of sense. Even last week, I had done a webinar on the opportunity in fixed income, and I do think that safety is a priority in today's market. See, with RBI reducing interest rate cycles, with RBI reducing interest rates lower, will bonds and debt funds lose? I mean, will they yield be affected and go down? So I think yields are influenced by many factors. Um, yields are so, for example, of course, interest rates play an important role, but it depends on how much transmission there is occurring in the economic system, right? So, if the RBI cuts rate, but banks don't cut rates, then you're not really going to see lower cost of borrowing or lower cost of funds. You do see transmission on the deposit side happen much faster than in the bond market side. So, I think that is something you need to consider. And I think as far as funds are considered, the transmission is higher in the government securities and maybe public sector bonds. And then as you move down the credit quality in the corporate bond ladder, the effect of interest rates is felt in smaller and smaller doses. So your yield being affected depends totally on where you're investing, how the portfolio is constructed. And if you've already invested in bonds, lower interest rates are actually a good thing because you'll get a mark-to-market gain through this change in interest rates. So as far as so for the next two questions, I'll not be able to answer this because any product specific question we are not allowed to advise on this. If you're an existing client, please reach out to us. We can review your mutual fund portfolio and we can help you take your investment decisions forward as well. Even if it's on the fixed income side, I think that is something we can do. Okay. So before we close, I think still we have 10 minutes. So if there are any questions, I'll still be here till 12 o'clock to answer them. But before we close, I'd just like to thank all the people who are there in the room today because you've come in, you've participated, you've asked a lot of very insightful questions, things that I've had to think about. And I hope I've left you with some learnings today after our Learning Saturday initiative. And I do look forward to seeing you in our next webinar, and it'll be great to have you on board as investors as well. So I think the next question also falls into the category of things that I can't answer. I think if you're looking at debt funds, it depends on what kind of risk you're trying to manage, right? So if you're okay with reinvestment risk, which is that, let's say you participate in a short-term fund, you, as time goes and transmission occurs, are you okay if your yield also comes down? If you're looking at a long-term bond fund, are you okay with taking duration risk, which is that if there is some yield volatility, you can make a loss in that fund. Are you okay with that? So in the first case, you don't really lose much, you just earn less with time. In the second case, there is upside potential, but there is also a downside potential. And I think in medium term also, it's similar to a long-term bond where you can have upside or downside risks that play out. So define what safety means to you, sir, because if you're talking about, I mean, see, the assets are in your name, but they're marked to market, right? So at no point can anybody take the money away from you. Uh, it's always mapped to your PAN and your mutual fund account. But if you're talking about in terms of guarantee of return, I think definitely bank and post office is a fixed return. So you do earn that fixed return. So if we look at Franklin also, the issue that they had was on the liquidity side, right? Because they had an asset liability mismatch, and that stems from the fact that they owned a lot of thinly traded bonds in their portfolio just to earn a higher yield, right? Meaning you have higher cash flows and you at the same time you're owning these bonds which you cannot easily liquidate if a client asks for money. The structure of a mutual fund is that they're supposed to return money to the investor whenever they ask for it. And I think within Franklin, they did not have too many defaults. And as far as I am aware, whatever schemes they shut down in 2020, they have returned the fund to the investor. So the risk that the investor bears in such a situation is that the time that they take to get their money back is uh, longer. I think in segregated portfolios from other AMCs, yeah, this is what requires due diligence, right? Mutual funds are a great tool, but you need to really understand what is within the portfolio, and not every investor has the bandwidth to do that research. And working with an MFD or somebody who's putting in that effort makes that difference. You might avoid all of these things. So on our distribution side, we had not recommended any Franklin funds in that era when this occurred. Now I think there are a lot of systemic changes within the AMC as well. So we cannot just look at the past and extrapolate to the present, but we do need to have a clear understanding of how the AMC manages risk. And I think fixed income is not an asset class that is so easily understood. Uh, yeah, but from that perspective, right, if you want a guaranteed, assured thing, no risk in terms of credit or quality, then of course there is no doubt that your post office or sovereign backed or bank deposit is going to give you that security. But you may also not earn anything more than what your fixed return is. Thank you, sir. It's a pleasure talking to you today. So I think we may not be able to share the presentation, but this video will be available on YouTube, and probably you can uh, see that at that point. Yes, this is one of the reasons why we don't look at hybrid funds on the mutual fund distribution side. We prefer to control the credit quality and the asset allocation as well. So we are aware of this. Yeah, fixed income is deposits, debt funds, bonds. Now, I think like for larger investors, you even have the AIF or alternate investment fund category. Again, based on your requirements. So, deposits give you a guaranteed return. Mostly, if you're if you're controlling the credit risk, I think your return is pretty much guaranteed, right? So, if you go with a bank, then for sure there is no, I mean, there's very minimal risk that a bank would recommend. Uh, if you're looking at some variety in returns, if you're looking at some level of more tax efficiency, I think debt funds make sense. You can look at that because you can buy and invest, you don't pay tax until you have to liquidate. So those advantages are definitely there in a debt fund over an FD. Uh, we don't we don't actually have credit risk funds in our PMS. And credit is something that you can only participate in cyclically. So that is something the investor has to take a call on. We are not running any AIFs, ma'am. It's an alternate investment fund. I think there the minimum investment is 1 crore. You can buy, it's like you can consider it as like a portfolio of bonds that may be listed or unlisted. Yeah, AIFs operate in that space because the advantage is that individual investors can always buy bonds, but with AIFs, you want to give that slightly higher return, right? So most people try to target, say, a 7% post-tax return, whereas in mutual funds, the return expectation will be 7.5% pre-tax or lower now that interest rates are moving lower. It's similar. So you just need to onboard with the AIF. You need to select a fund. You have to, there will be certain KYC requirements. You need to have a demat account and you can open your account. So if you're interested in this, you can always message us, I think, and see what can be done. Let me just move to our contact details so that in case you have any product questions, I know there were people who are asking portfolio specific questions. Let me just share the number as well. So 9500027285 in case you want to ask us something that we've not been able to answer on a public platform and that needs to be discussed on a one-to-one basis. Yes, the AIF ticket size is 1 crore. So on income plus arbitrage, again, you need to consider whether your horizon is 2 years and what the arbitrage as well as fixed income spreads are at this point. I think from our perspective, it makes sense to, I mean, if you are trying to avoid tax, then yes, it's a more tax efficient choice. If you're not trying to avoid the tax and you want more safety or predictability in returns, then I think pure debt makes sense. All right. So I think we've reached the end of our webinar. Thank you everyone for coming in. Thank you for asking questions. We will end our session today, and I do hope to see you at another one of our webinars soon. And if you have any questions, please feel free to write to us at 9500027285, and our team will get back to you. And thank you.